Good afternoon and welcome back to our Options Education webinar series. Thank you so much for taking the time out this afternoon. Today we have a fairly special webinar for you on talking about how to prepare your portfolio for a recession. And today what we're going to do is we're going to start off by talking a little bit about the current market's outlook. What I want to talk about is some recession statistics and hopefully put it in context as far as where we currently are with respect to some of those statistics that we look at with a recession coming on, and really understand how we stand after this decade-long rally that we've currently been in, to understand when and where we might expect to see a recession. Now, today what I'll do is, once we kind of put the recession in context, I'll walk you through a few different options that you may have to prepare your portfolio for a recession, and talk a little bit about how to hedge your portfolio in a downside move that we might expect in the markets during a recession. So we'll talk about who and when portfolio hedging is a suitable strategy for, and this webinar does require a basic understanding of call or put options, just for those of you that are newer to options trading. For those of you that are experienced with options trading, you might have learned about options, hedging a portfolio with options. So we're really here to make sure that you guys understand how to go about doing so. And the difference between this webinar and some of the previously recorded webinars that we've done on hedging is today I want to spend more time going through real examples, walking you through actual portfolios, showing you how to leverage OptionsPlay to look at different portfolio hedges and see the different outcomes that you will have if you were to put on a portfolio hedge, and at the same time also show you some alternatives if you don't want to go ahead and place a put option on your portfolio, what you can do. So the webinar itself is going to be recorded, and for those of you that are brand new to OptionsPlay, you will receive the slides afterwards, so you can follow along at your own pace if you want to take the time to review the information that we're going to go over here today. So before I get started, OptionsPlay is a free 30-day trial for those of you that are brand new. You can sign up at the link below, which I will add to the chat window right now for those of you that want to sign up for a free 30-day trial. Membership is $50 a month or $500 a year, and as included with that, you do get a free 12-step options trading course to help you get jump-started if you're brand new to options trading and you're still in the learning process. And even for those of you that are current subscribers, if you want to access those courses, please just click on that link and you'll be able to get a copy of that course. So let's go ahead and get started. We'll talk a little bit about current market outlooks and expectations based on certain indicators that are important in predicting a recession. We'll talk a little bit about what are your options, if you will, that you can deploy in your portfolio to prepare for a recession. And then what we'll do is we'll spend some time talking a little bit about a portfolio hedge, meaning buying a put option to protect your portfolio against a downside move during a recession. Now, we'll go through the different scenarios that you might come across, the different expiration dates and strike prices that you would typically select on a portfolio hedge, and just general best practices for how to manage a hedge on a portfolio. And then what we'll do is we'll jump over to OptionsPlay, show you some examples, show you different expiration dates, different strike prices, so that you can really see how to utilize our tool to become self-sufficient in being able to analyze a hedge on your portfolio. So before I get started, I just want to do a quick poll here of the audience here in the room. How many of you expect to see a recession in the U.S. over the next 3 to 6 months, in a relatively short period of time? How many of you say yes, how many say no, and how many of you are not quite sure? Okay, so about 2/3 of you voted, and looks like no's outpaced yeses about 3 to 1 actually, and about a quarter of you say you're not sure. So 60% say no, 18% said yes, and 22% said I'm not sure. So I would say that the sentiment of the room of 3 to 1 yes, no's to yeses is, in my opinion, the right opinion, and I'll talk to you and I'll show you why. And for those of you that are not sure, hopefully this helps give you some context as to why we feel that a recession in the next 3 to 6 months is unlikely. So let's go ahead and move on here. So first, what I want to talk about is what do we look at to try to predict market recessions? And one of the indicators that has worked quite well historically is looking at the spread between the 10-year and 3-month treasury yields. And the reason we look at this is because when participants in the market lose confidence in the market, they start to buy longer dated bonds, and they buy them at such a pace that they effectively the 10-year bonds are actually paying a lower yield than short-term bonds, and that reflects our lack of confidence in the markets in the short term. And that's really when we see the 10-year versus the 3-year treasury yields turn negative. And this is something that we just saw happen in late May. So we just saw the inversion in late May. However, what's interesting about this indicator is that even though this indicator preceded the last 3 recessions, it did so with about an 18-month lag. So meaning when this happens, the recession typically takes almost a year and a half before the recession actually starts to hit. So in 2008, this actually started happening in late 2005 before the recession in late 2007 occurred. .com was a little faster, and the one before that was about 20 months or so. So on average, when the yield curve inverts, we actually see that there's still quite a bit of time left before the next recession. So even though we do have this flash warning here, letting us know that the market is anticipating some difficulties ahead, typically, actually the period between now and the actual peak, the markets still move higher. So even though right now we do see some economic slowdown, but U.S. equities still remain one of the strongest asset classes around the globe. There are still a few things that I think are potential supports for this market, even as things slow down. I think first of all, and this is one of the reasons why we've seen a bit of a rally off the lows of last week, was really the potential of a central bank rate cut. I don't think we can discount the power of the central bank. So if the central bank decides to cut rates, this is certainly one thing that may support the markets. Other things as far as tariffs, which is one of the drivers of the weakness we've seen over the last few weeks or the last few months. There's the possibility of Congress intervening on those things. So there's some binary risks that we see that it can either work in our favor or against us. This makes it somewhat difficult to trade because it's really difficult to predict these types of things. However, the one thing I think we should focus our attention on is the fact that the S&P historically is positive 3 to 6 months after the inversion. And as you can see, here are the different lag times of how long it takes between the start date of the inversion to the actual start of the recession. As you can see, the average is 19 months. This means that we expect the markets to still continue moving higher, even though we've gotten this flash warning. And that's really, I think, what we should focus our attention on. However, the fact that we have this warning sign is, I think, time to start thinking about how do we prepare our portfolio for a recession. And this is really why we want to take a little bit of time and understand what are our options. Even though we're still bullish on the markets, this pullback that we recently got is potentially a buying opportunity for a lot of investors. But in the long run, how do we actually think about preparing our portfolio for a recession? And the answer is there's quite a few different options that you have to protect your portfolio or position your portfolio for a recession so that you don't take the same amount of losses as the whole market. And so the few different of options that you have, first of all, I think what we should do is make sure everyone understands is that there is a thing called a perfect hedge. And that perfect hedge is simply moving your assets into cash and waiting for the markets to correct and reinvest after the correction. Now, you can move into cash, you can move into cash equivalents like money market funds or CDs. Those are all potential safer investments, if you will, that allows you to effectively lock in your profits at the top and potentially reinvest them near the bottom as the markets correct during a recession. But keep in mind that we're not necessarily saying we're at the top and that you should start moving your assets to cash. We're simply saying that this is one of the options that you have when you feel that the recession is about to start. So, 60% of you say you don't expect a recession in the next 3 to 6 months. So this is not something that you necessarily need to be doing right now. But when you do find that recession is going to come in that next 3 to 6 months, or you think it's going to be along those lines, that's when you want to start thinking about these strategies. Now, the second most popular strategy is to really start reallocating to defensive assets. This is something that you can start to do as the markets have been in a decade-long rally. You always typically rebalance when things start getting out of whack, and when equities become a larger and larger percentage of your portfolio, it's time to reallocate some of those gains into more defensive assets. Traditionally, fixed income is usually where most users will go. So bonds, treasury bonds, investment grade bonds, these are usually places that you would start placing some of those equity. As you sell your equities for a profit, you will start reallocating some of those towards fixed income. I will say that on the fixed income side, if you're going to put your money into bonds, you want to generally avoid high yield bonds during these types of times when you expect a recession to happen. Another solution that you have is potentially high dividend paying stocks. High dividend paying stocks has historically shown to be a defensive sector and outperforms lower dividend paying stocks during a recession. And lastly, potentially gold and commodities are also potential hedges for a downside or a recession. And I will say that generally speaking, precious metals and natural resources like gold will typically hold up well, but there are certain commodities like oil which typically do not hold up very well during recessions. So the idea is to really get yourself away from asset classes that are highly correlated to equities and move yourself into asset classes that have lower correlations to equities. And lastly, what we're here to really spend some time going over is a portfolio hedge by buying a put option to protect your portfolio during a downside correction or a recession. Now, a portfolio hedge out of all of these three options is useful when you have a portfolio of stocks or ETFs and you're trying to protect yourself against a correction that's greater than 5%. So generally speaking, if we're thinking about a recession, we're generally concerned about a correction greater than 5%, because a correction less than 5%, I would not call that a recession. And the key here about a portfolio hedge is that it's really only applicable if you want to hedge your portfolio and you do not wish to sell any of your holdings, or at least you plan on holding on to part of your portfolio. And the reason for this is because, going back to the first step, is that if you have the ability to simply sell your positions and either reallocate them to cash or reallocate them to other asset classes, then you don't need a portfolio hedge. You only need a portfolio hedge if you want to remain invested in those stocks and ETFs. And there are various reasons as to why you may want to do that. Certain users here may have low cost basis stock and you don't want to sell your stock to generate a tax bill, or maybe you rely on some stocks for the dividends as an income stream. For various reasons, you may want to remain invested in those stocks, but you want to make sure that you're able to protect yourself during a recession. So buying a put option on your portfolio is an option for you to do so. But I, again, want to point out that there are other options that may provide you with better hedges before you consider a portfolio hedge. So today, what we're going to do is we're going to dive into portfolio hedges. We're going to break them down in terms of what they are. They're actually fairly simple to understand, but we will spend a little bit of time to show you the different portfolio hedges that you can actually place, go through some live examples, so that when the time comes, even though many of you do not feel that a recession is coming anytime soon, when the time comes, that you are prepared for how to protect your portfolio with a portfolio hedge. So with that, I'll first define what is a portfolio hedge, because it's pretty simple to understand. It's simply just an insurance, or think of it like an insurance policy that protects your portfolio during a market correction. And you can do it by simply buying a put option on a broad-based index, either ETF or an index option. And what this put option provides you with is profits if the markets were to correct, which will offset the losses that you have on the actual portfolio. And this creates what we call an imperfect partial hedge. And this is part of why this is one of the reasons why we always make sure that you understand how hedges work, because it's not going to provide you with dollar for dollar. It's not going to protect your portfolio dollar for dollar like an insurance policy. And you get to choose how much protection that you want. So this is really why we want to go through as many examples as possible so that you really understand how to look at these portfolio hedges and understand how they will and should perform when the market's correct. Now, one of the, I think, most important things for users to understand is that portfolio hedges on paper sounds great. Why would I not want to protect my portfolio during a downturn? Everyone would want to, because you certainly don't want more higher losses in your portfolio during a recession. However, it's really important to understand that putting on a portfolio hedge is expensive. It creates a portfolio drag if you were to try to do so constantly. So it's not something that you can just constantly buy protection for, like you buy car insurance or your insurance for your house. This is something that you can only really afford when things hit the fan. So it really requires active management and timing, and that's why this is something that is slightly more advanced, but it does at least expect, when we're going to go through this, we do expect you to have a basic understanding as to how put options work. But like I said, this strategy is very sensitive to timing and requires active management. So it's not quite something you can just buy, set, and forget like an insurance policy on a car or a house. So that's why we're going to go through examples of this and show you how to actually go about timing entries and exits and how to select the appropriate expiration dates and strike prices to hopefully help reduce the expense of providing a portfolio hedge on your portfolio. So a portfolio hedge, just illustrative purposes, very simple. We start with the stock portfolio. A stock portfolio that you have will give you unlimited profits as the markets continue to go higher and higher. It will also provide unlimited losses all the way down to zero until you've lost everything. So it's a dollar for dollar exposure that you have with your current portfolio. If you have an equities portfolio, a portfolio hedge is simply buying a put option on an index or ETF. A put option will basically cost you a certain amount, so no matter what happens, the most you can lose is the amount that you pay for that put option. But as the markets decline, as the markets move lower, you make more and more money on that put option. So when you combine the stock portfolio that you have with the put option that you purchase, what you end up with is a portfolio that looks something like this, where you still maintain that unlimited profits to the upside if the market keeps going higher and higher. But at some point, if the market keeps going lower and lower, you have capped your losses so that you cannot lose more than a certain amount. Now, this is a bit of an oversimplification of the strategy, but overall, this is generally how the strategy works. So now let's actually break down the specific strategy and talk a little bit about these specific putting on a portfolio hedge. So number one, what I want to show you here today, because of how expensive placing a portfolio hedge is, when you generally only want to enter a portfolio hedge during a correction. What do I mean by this? Meaning what we generally do not recommend is for you to put on a hedge prior to the market starting a correction, trying to anticipate that the markets may correct. Because if you do that, chances are many times, 6, 7 times out of 10, you might find yourself in a position where you've put on a hedge to anticipate the markets to correct, and it simply doesn't happen, and what you pay for that put, you lose everything on, and it puts a drag on your portfolio because you're paying for very expensive insurance for something that may not happen. Versus one of the great things about a hedge is that you can purchase insurance as the market starts to correct. Unlike a car insurance, you have to purchase the insurance before you have an accident. Here, you can actually purchase insurance as the market corrects. So when you time a portfolio hedge, you can do it during a correction. It'll be a little bit more expensive, but you're not buying unnecessary protection. And on an exit, you want to exit as soon as a correction is over. Now, I get a lot of questions as to how do you know when a correction is over? And the answer is, generally speaking, you can look at volatility indicators such as VIX to give you a sense for when a market is near its bottom. Because if you ever looked at a chart of VIX, it's very, very spiky. And the spikes refer to times when the markets are near its bottom. So those are times that you can utilize volatility type indicators to help you time when the markets are near a bottom. So Now that we've talked a little bit about when to get in, when to get out, how do you actually pick what to utilize for your hedge? And this is really where you want to pick some kind of index that's closely correlated to your portfolio. So for those of you that have a fairly well diversified and balanced portfolio, you would typically use a broad-based index like the S&P 500, which provides pretty good coverage for any well-balanced, well-diversified portfolio. However, chances are many of you have portfolios that have a focus in a particular sector or a particular asset class. So generally speaking, if let's say you have a very strong tech portfolio, you may want to pick an index that has more heavily weighted towards tech, like the NASDAQ 100 index. Or if you have an energy focused index, or maybe you work in a specific industry, so you have a lot of stocks in that one, with companies in that one industry, you might want to use a sector-focused portfolio. The great thing about the proliferation of ETFs is that you can find an ETF that pretty much matches all different types of exposures that you may particularly have in your portfolio, and pick an ETF that closely mimics the holdings of your portfolio. And that's really one of the great things about trading in the US markets, is that you have so many potential things to select from. And even if you have concentrated position in a single stock, maybe you've worked for a company for a long time and you just have 80% of your portfolio in a single stock, you can then just buy puts on that single stock if you like. So there's a lot of potential opportunities here. It's just a matter of finding the right index or ETF or individual stock that closely mimics your portfolio. So we'll go through a few different examples here in a little bit. So let's talk a little bit about expiration dates. So we know that buying a portfolio hedge requires buying a put, but do you buy a 1 month put, a 3 month put, a 1 year put? Where do you go? The answer is looking at the time decay curve. The time decay curve tells us how much the value of the option will decay by if everything else is constant. And as you can see, the time decay curve actually accelerates as you get closer and closer to expiration. So because we're buying an option and time decay is working against us, we generally want to be further out in time and make sure that the time decay is working as slowly as possible, because the faster the time decay works, the more it eats away into our profits of the puts that we purchase. So when we're buying put options to hedge a portfolio, we generally want to buy at least 2 months out, usually a little further out. Usually 3 to 4 months is typically suitable for a portfolio hedge, because when you buy an option that's 3 to 4 months out, you can hang on to that trade for a month and a half without seeing much decay in the price of the option due to time decay. And the goal here is to really just minimize your time decay factor on a long put. So that's how you go about typically selecting an expiration date. As far as selecting strike prices, now I used to have a couple of slides going through in detail the difference between a catastrophic and comprehensive insurance, but I think the best way for me to really illustrate this is to really just show you examples. So when you're thinking about strike prices, most of these options give you hundreds of strikes, and it's really difficult sometimes to figure out exactly where to start. So generally speaking, you should think, first of all, ask yourself when you're picking your strike prices, am I trying to buy protection against a catastrophic move? Meaning, am I afraid of a black swan event or a fat tail event that might wipe out the 20% of the markets in just a few days, like we saw in December? Or am I concerned more of a long-term structural issue where I think that markets are going to head 50% lower over the next 2 years? Because that will typically help you determine which one of protection that you want to buy, or different levels of protection. You can think of it like insurance. You can buy catastrophic insurance, or you can buy comprehensive insurance. Same thing here. So if you're looking to buy just catastrophic insurance, which means to protect yourself against a major downside correction, that's when you want to buy out of the money puts. Usually about a 30 to 40 delta put is a good starting point. And this will typically cost anywhere from 1 to 3% of your entire portfolio value to buy these types of puts. Conversely, if you wanted to buy comprehensive insurance, which will give you protection in any downside move, then you will buy in the money puts. Usually a 50 to 60 delta is a good starting point. This will typically cost anywhere from 3 to 5% of your account value or the portfolio value that you want to hedge. So this is something that you should utilize. These are the two options that you have when it comes to selecting a strike price. So what I want to do is I want to show you some real examples to actually compare these two strategies or these two strike prices so that you can make the comparison yourself and decide which one's more suitable for you. So just a quick summary of what I've spoken about before I jump over to OptionsPlay. When you're thinking about a portfolio hedge, one of the most important things to remember is that constant hedging is not cost efficient because hedging is an extremely expensive sport. Don't do it. Don't do it unless you absolutely have to. In my opinion, it's actually best to be late than early. A lot of people try to buy protection early when the markets are near the top because they say, options are really cheap. I can buy some really, really cheap protection for less than 1% of my portfolio. Why not do it? The answer is because 7 out of 10 times you do that, the markets just continue moving higher and you lose 100% of what you paid for that put, no matter how cheap it was. And that's really the drag that you put on your portfolio when you buy puts all the time near market tops. And a much better way to help you determine or offset the cost of a portfolio is to be late, but as opposed to early. And then what you can do is you can sell cover calls to offset the hedging cost of buying those puts. So when the market's correct lower, you can sell pretty aggressive cover calls to help pay for some of those downside puts. And you're okay with selling pretty aggressive calls when the markets are dropping. So this is usually one of the better ways, in my opinion, to offset the cost as opposed to being early and anticipating a move. And lastly, you can choose between buying in the money puts, which provide you far better overall protection, versus out of the money puts, which only provide you protection in a catastrophic event. So what I want to do now is I want to jump over to OptionsPlay. I want to show you how to compare different hedging strategies, use the P&L simulator to really compare different strategies side by side, and so that you really understand the different structures that you can deploy for a portfolio hedge. So with that, what I'm going to use is OptionsPlay. For those of you that are brand new to OptionsPlay, welcome. This tool is really designed from the ground up to try to make your options trading as intuitive and as easy as possible and really allow you to explore different strategies side by side so that you can learn more about the risks and rewards of each trade before you actually go ahead and execute them in your account. So the platform itself is divided into 3 sections. We have trade ideas, watch list, and portfolio on the left-hand side. In the middle is our security analysis panel. On the right-hand side is trading and income. So we call these 3 panels the what, the why, and the how of options trading. So what symbols do you want to look at? Fresh trade ideas scanned for you every single day. Watch lists that are already pre-built for you, and you can add your own symbols to the watch list. To quickly scan for opportunities for what symbols you want to take a look at. The middle panel gives you snapshot technical analysis data so that you can see how assets are doing. So 1 month and 6 month trends of any stock that you're looking at. So right now I'm looking at the Qs, which is the NASDAQ 100 ETF. As you can see near the market tops around 190, our trend indicator started to show weakening in the trend quality here in May 7th, and then really deteriorated here on May 9th when the trend started to turn bearish, and both things really got bad here on May 17th, and that's kind of when we've seen the subsequent move to the downside. Things got a little oversold here, I'd say, here on June 3rd before the markets rallied back up over the last couple of days. Trends still look fairly poor right now, so until this market starts to recover higher, the Qs really have to get above 178 or so, which was this low here, for us to kind of even attempt to resume a bullish trend. As long as it stays below 178, I'd say that there's a higher chance that this market corrects lower back towards that 163 level, in my opinion, on the Qs. So let's take a look at some examples here. So what I'm going to do is I'm going to use the trading tab to show you how to set up a portfolio and set up 2 hedges against that portfolio. So what I'm going to do is I'm going to select I'm bullish and use this stock leg to simulate my portfolio. I'm going to use this 2 screens on the right-hand side to buy some puts. So I'm going to use my strategy constructor. I'm going to select a bearish strategy. I'm going to pick the first strategy, a put, a very simple option strategy. And I'm going to select maybe a September expiration. So let's say I think over the summer things are going to be a little slow. Uh, China certainly slowing down. That's going to have an effect on all of us and global economies. China is a very large economy now. Unlike the last recession when China was significantly smaller, it has a much larger impact when they do slow down. So those are some of the headwinds that I currently see in the market. So even though I don't see a recession coming on, I do see that there is potential of headwinds. So I'm going to also modify this third strategy on the right. I'm also going to buy another put. But now what I'm going to do is I'm going to buy different strikes. So here I have 2 Septembers. Normally you'd have to pull up an option chain, then you look at different expirations and strike prices. But if I told you that I think the Qs are going to go back to 162, how much money are you going to make from a 180 put versus 170 put? If you're just looking at an option chain, you're not going to know, which is why we built OptionsPlay. We wanted you to be able to quickly look at a trade. So let's say I want to buy this 183 put versus that's an in the money put versus buying an out of the money put, maybe a 170 put. So this is about $7 below the current price, and this is about $7 above the current price. So I have a 184, 170 put. And what I'm going to do in order to simulate a real portfolio is I'm going to use our risk and investment calculator. And I'm going to put in my portfolio sizes, the amount that I'm invested in the market. So let's say I have a $200,000 portfolio. What this does is it shows me that a $200,000 portfolio is roughly 1,100 shares of the Qs, which means that I can buy 11 puts to hedge myself here on the September 2180 puts or the September 170 puts. So both the in the money and the out of the money. And remember, the in the money option is what we consider the comprehensive insurance, and the out of the money puts are what we call the catastrophic insurance. So as you can see here, this is a $200,000 portfolio to buy 11 contracts of the in the money puts. This is the comprehensive insurance. Cost me about $11,000. Buying the out of the money puts cost me half as much, about $5,000. So as you can see here, buying these puts here will cost me roughly about 5% of my portfolio. So that's quite an expensive proposition versus this will cost me about 2.5% of my portfolio, about half as much. So this really allows me to say, well, okay, so I have a $200,000 portfolio. To buy a hedge here will cost me 11 grand, which is quite a bit. This will only cost me $5,000. So which one's best? And the answer is you don't really know until you actually put these two side by side, put in the different scenarios and see how they perform. So first, let's just start off by saying what happens if between now and September, the markets fluctuate a little higher, fluctuates a little lower, but it doesn't materially move much higher or lower. What happens if at September expiration, the market stays exactly where it is? Now, you would think that, first of all, if the market stays exactly where it is, I would certainly say that neither portfolio hedge is really going to be very useful. But as you can see, even though this comprehensive insurance costs more than double what the catastrophic insurance costs, as you can see, if the market stays where it is, around 177 by the expiration date, my comprehensive insurance, even though it costs me substantially substantially more, will only lose $4,000 versus the catastrophic insurance will lose $5,000. So even though I've made $0 on my portfolio, here, by buying protection, I'm going to actually lose less money, even though it costs substantially more than the out-of-the-money puts. And this is one of the reasons why I advocate when you're buying insurance and you're buying it late, you're better off buying comprehensive insurance, even though it's far more expensive. It's because it does give you additional benefits so that even if the markets stay where it is or move slightly lower, you get some significant benefits. So for example, here, even if the market was to move lower, let's say it moved down to 170, not much lower, but a little bit lower. As you can see here, I'd lose $8,000 on my portfolio if the markets went down to 170, but I'd make $4,000 back on my comprehensive insurance. If I bought this cheap insurance here, which cost me half as much, certainly cheaper, as you can see, I lose an additional $5,000. So here, not only do I lose $8,000, now I've lost another $5,000. So now I'm down $13,000. So even though I bought protection and the markets went down, I'm still losing actually more money than if I didn't even buy protection at all. So this is really why, from my perspective, cheap insurance only gives you catastrophic. It really gives you it only gives you coverage in a catastrophic event. And what I mean by that is that it really requires a significant move to the downside before this strategy starts to pay you anything. So as you can see, if the markets move down to 160, now I'm losing $19,000 on my stock portfolio, but I'm making about 6,000 of that back in my catastrophic insurance. Notice that the comprehensive insurance pays me $15,000. So even though I've lost 19 on the portfolio, I get 15 of that back. So I'm now only down $4,000 where I'm normally down almost 10%. I'm only down roughly about 2%, or rather, 4% rather, sorry. And then on the strategy on the right, out of the 19 grand, I make about $6,000 back. So I'm still down about $13,000. So this is really where you can utilize our tools to not only see how these strategies perform when the markets move lower, or if it stays exactly where it is, and more importantly, what happens if the markets move higher? How much money do I make? How much money do I lose? This is really important for users to understand the different scenarios. So let's say I put on this hedge today, and for whatever reason, maybe the Fed steps in and says they're going to cut rates and the markets rally sharply off of that. Maybe let's say the markets go back up to that 190 level. Let's say by the end of June or maybe by July, mid-July, as you can see here, the markets sharply rally back up to 190. Right? So this is the type of scenarios that we actually historically see after the yield curve inverts, is that markets actually march higher after that happens, even though it's a bit of a warning sign to us. Markets march higher. As you can see, when that happens, we would make about $14,000 in our portfolio. In the comprehensive insurance, we lose $7,500. In the cheap insurance, we lose about $4,400. So as you can see here, the difference between these two are certainly worse in the comprehensive insurance, but I'm still overall not losing money because I've made $14,000 in the stock portfolio. I've lost $7,500, about half of that in the comprehensive insurance versus only $4,400 on the catastrophic insurance. So this is really how you can utilize this tool to say, what are my best case scenarios if the markets does move lower? And what are my worst case scenarios if the markets sharply rally after I buy this catastrophic or comprehensive insurance? And this tool is really designed to allow you to provide any outlook that you may have on the markets, whether it's severely to the downside or even anticipating what happens if the markets rally. How much money do I actually make? How much money do I actually lose? And you'll see that in most scenarios, especially when the market moves just a little bit lower, that comprehensive insurance, even though it costs you substantially more, will give you far better coverage, in my opinion, compared to buying an out-of-the-money put, which really is useless until the market drops 15% or 10% plus on a portfolio, where most of the other time you just end up losing $5,000, even though it's a smaller dollar amount. But I'd rather not have a scenario where I have a higher probability of losing most of my money on a put option. I typically only buy puts when things really are starting to get ugly. It's going to be expensive, but for that, I get far better coverage. And that's my personal philosophy when it comes to buying puts. And what I'll do is I'll go through a few different examples as well. You know, for some of you, if you have a concentrated stock position, I see this a lot from users that maybe have worked for a company and have been paid in stock. So, you know, I have a few different clients that have worked for IBM for a very long time and have built very, very large positions in IBM, and their portfolios are concentrated in IBM. You might find yourself in a similar position. So what I'm going to do is I'm going to simulate the exact same thing. I'm going to buy some puts this time instead of on a broad-based index like the Qs or SPY. I'm going to buy some puts on IBM. So let's say I'm looking at the same thing, September. Here I'll buy maybe 125 put versus a 135 put. And what I'll do is, let's say this person has, let's say $250,000 in IBM stock that they own. So about 1,800 shares. You can buy 19 contracts of the puts here to protect yourself. So $250,000 portfolio, $11,000 to buy the in-the-money puts, $7,200 to buy the out-of-the-money puts. The catastrophic insurance, $7,000, comprehensive insurance, $11,000. So let's take a look and say, well, what happens if IBM's turning at 132 right now? This stock has really kind of swung between 145 and 107 to the downside. So there's a pretty big range here. So let's say this stock does make its way back down to this 125 level down here, which was these highs back here in November and December before it really beat on earnings and had this huge gap higher. I think it's probably likely to go back to retest those 125 levels. So let's say the stock rallies, declines back to 125 at the end of summer. As you can see on the stock leg, you'd lose 14 grand, but you make 7,800 of that back if you had bought this slightly more expensive put. It'll cost you about $4,000 more, but as you can see, instead of losing 14,000, I'm going to make 7,800 back. So roughly roughly half the amount that I've lost, I'm going to make back by buying this comprehensive insurance. Versus if I bought the cheap insurance, I'd lose an additional $7,200. So from my perspective, that's got to hurt to buy protection for you to be actually correct on that move where the stock moved lower and then actually lost money on that hedge. And this is one of the reasons why I personally don't love paying for that out of the money put, because even the markets move lower, you can still lose money. And that always hurts to be able to call that move to the downside correctly, do something about it, and then actually lose more money from it than you would have if you didn't buy any insurance. Versus that comprehensive insurance, as you can see on a move down to 125, will have hedged half of the losses that I have. Now, if the stock does move to the downside all the way down to 108, which was the December lows, and I don't think it's that crazy for if the markets were to kind of get a little uglier to revisit those 107 lows, as you can see, if that happens, I'd lose $48,000 on my stock, but I make $42,000 back on my comprehensive insurance. So I'm at that point making, in my opinion, almost dollar for dollar back any losses that I have on my stock. Versus here on the comprehensive puts, I'm making $26,000 back. Certainly makes that $48,000 loss a lot easier to swallow, but still not dollar for dollar protection, about half the protection that I'm really getting. So here I'm losing almost 50. I get about 26 back, about half of the losses that I get back. So just to save that extra $4,000 or so, in my opinion, and give up, another $24,000 may not be worth it. So this is really where you can make the comparison yourself. Don't take my word for it. Put in your own outlooks on an individual stock or market that you feel the markets are going to move lower on. And maybe you expect that stock to move in a shorter time frame. You can utilize this tool to also model what happens if the stock was to move down to 107 in a shorter time frame. How much money do you make on this particular trade? This tool really allows you to be very flexible, put any two strategies side by side, comprehensive and catastrophic insurance. Hopefully what I've been able to do here today is show you how you can set it up, and then you can utilize the P&L simulator to say, how do these strategies perform? And for those of you that are a bit more advanced, you can even use I used the July here, so that's why. Let me switch this to September. So in the September one, I think you'll still see that the results are fairly similar. If the stock was to move down to 125, yeah, okay, so a little different, but not that different. If the stock was to move down to 125, instead of making $7,000 back, I make $3,600 back, but certainly make some of it back if the market was to move modestly lower. But as you can see, again, the out-of-the-money puts will cause me to lose all of my money. But if it does make that catastrophic move to the downside, instead of losing 48, I make 37 back. So I'm net down only about 10,000 as opposed to 48,000, versus here I'm only getting about 26 back. So hopefully what I've been able to show you here is the flexibility of this platform to allow you to mimic any portfolio with this strategy here on the left-hand side, plug in any two puts that you can buy, whether it's, and you can compare different expiration dates. So you can compare a September to a November put, or both Septembers with different strike prices. You can be very flexible in really choosing the different scenarios, utilizing the P&L simulator and seeing how each strategy performs, and see, what is my worst case scenario, what is my best case scenario, and be able to actually pick the strategy that's best for you, unlike when you look at an option chain where you're kind of just guessing. And even if you're a professional trader, you find yourself doing just back of the envelope math many times on an option chain to figure out where is the starting points. This tells you exactly how much money you expect to make or lose on a specific trade. So with that, that covers what I wanted to show you guys here today. I hope that you really have found this useful and really understanding, number one, where we currently sit and with respect to a potential recession, and then more importantly, how do you actually position yourself when you anticipate a correction in the markets or a larger structural downside move in the market. So with that, what I want to do is I want to thank everyone for taking the time out here today. I'll open this up for Q&A. So if you have any questions regarding anything I went over here today, feel free to shoot me feel free to type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for here today. Thank you. Elaine, thank you so much. I really appreciate it. Any questions regarding anything? Wayne, thank you so much. I really appreciate it. Alfred saying, please explain 30 to 40 delta. Delta is referring to the probability of the put being in the money. So a 30 to 40 delta put refers to a put that has about a 30 to 40% chance of being in the money. And you can find the deltas by clicking on the strategy in Greeks here at the bottom of any strategy. As you can see, it'll tell you the deltas. So here what I'll do is I will, let's modify this back to one contract so that you can see that this is about a 35 delta. So right in the sweet spot of what we're looking for in a out of the money put. In a general suggestion, there's no date and time in the main page of the OptionsPlay web page. I have several snapshots of the pages where so I believe, I think you asked me this question the other day, and you can save any single trade. So let's say I want to look at this IBM put, and I want to save it, and I want to be able to track it. You can click on this little link here on the right-hand side, and what that does is it saves the trade for you. This is the same link that we send you the daily plays in, and what it does is it saves the trade in your profile. So you can go to your profile, you can go to your saved trades, and you can see, hey, on June 6th, at 5:02, I saved this trade, and you can click on the trade, and it'll bring back the trade and show you the actual P&L of that trade. So not only do we give you the timestamp and the date, we show you the strategy that you traded, but we also track the P&L. So you can actually pull up any historical trade. So this APD trade that we have from a few days ago, you can pull it up, and you can see, oh, this trade is up $460, and you can see that this trade was made on June 4th at was this 9:09 at night was when I published this trade, and you can see this. So we actually have all of that for you if you're interested in saving a trade and tracking it for your purposes. Steven saying, how do you feel about buying inverse ETFs when the market is in a big downtrend? That's a great question, Steven, and I think that a lot of people have similar thoughts. The problem with buying an inverse ETF, number one, if you were to buy an inverse ETF to hedge your portfolio, you'd have to put up a lot of cash. So let's say you have $1 million portfolio, even if you buy a leverage ETF, you'd still have to put up a substantial amount of capital. Buying a put only costs you a few percentage points of your entire portfolio. So number one, that's my thoughts on using an inverse ETF, is that it requires substantially more capital. And number two, inverse ETFs only provide an inverted hedge over a very short period of time. If you look at the perspective of any inverse or leverage ETF, they only provide you with the inverse for a single trading day. Meaning, if let's say the stock market goes up 2% that day, or if the market goes down 2% that day, an inverse ETF is supposed to give you a 2% return or 2% positive return. But if the market goes down 20% over 2 months, it's not going to give you a 20% return to the upside over those 2 months. It might only give you a 15% upside for those 2 months. So keep in mind that inverse ETFs are not meant for long-term hedges. They're only meant for very short-term hedges. So keep that in mind. Alan saying, I currently trade options against vol using VXX. Can this be used as a general hedge for this purpose instead of other indices? Yes, however, if you expect the markets to move down by 20%, how much do you hedge VXX by? And the answer is you don't know, because VXX does not have a specific move for a 20% downside move. So you can, but it's not a dollar for dollar move, and it's very hard to judge exactly how many contracts to purchase. Bradley saying, if we can control, for example, $200,000 in S&P futures contracts with roughly 5% capital versus controlling the same 200K by buying call option, which might require more capital, can we consider the savings and margin as a good usage to buy a put? Bradley, I'm happy to answer that question, but I'd like to think about that a little bit before I answer that live. So if you don't mind, send me an email at info@optionsplay.com. It's a really good question that you brought up, but I'd like to think about that a little bit more before I answer that. So I sent you a link in the chat window with my email address. Shoot me an email with that specific question again, and I'm happy to take a look at that deeper. When would you sell a call to finance a put purchase? Great question. So let's go back to the IBM example. So in that IBM example, I'm long. I'm going to buy a put. Sorry, buy a put. Whoops. And let's look at a few different puts. So let's look at the September. Before I was looking at the 135s, I think, or maybe the 140 puts. Let's say I'm looking at the 135 puts, and then I was looking at the September 125 puts. Those are the two that we're looking at, right? And let's say I have that $200,000 portfolio or $250,000 portfolio. So as you can see here, to buy this 19 contracts of the September 135 puts cost me $15,390. So what I would do is I would sell some puts against that. So maybe I would sell, first of all, I would sell shorter dated puts, but I can sell maybe a 135 put. Whoops, that was the wrong one. Let's say I'm going to sell a 135. Maybe I'll sell a July one. You can sell an upside put. You can sell a 135 put. So as you can see here, between now and July, if I sold the 135 puts, I can collect $2.06 versus paying $8.10 for the puts. So I'm collecting roughly a quarter of the cost of that put in just 36 days. And if I'm expecting the market to move down, selling a 135 put is usually not a problem. And this captures a quarter of my hedging costs in just about a third of the time. So in theory, I could sell 3 of these puts over the next 3 months and collect roughly, let's just say, $6. And that means that instead of paying $8.10, I might collect, let's just say, $5 or $6 in premium by selling that upside call. And you can always use the income tab, the cover call tab, to figure out which calls to sell. So selling the June 28th 138 cover calls collects $53. And I can utilize this tool. So maybe because I'm very bearish on this trade, I'll get a little bit more aggressive. So let's say I sell the June 136 calls, which will collect $103 in just 22 days. So I have 100 and what? I had 100 and how many days till September? 106 days. So 22 would be about 5 times that. So, if I sold those June 136 puts, 136 calls, and I can do that 5 times, that's collecting roughly $5 over those 100 and some odd days. So that's really an example of selling puts to generate some income for buying those puts. Michael's saying, how do you account or compute the correlation between an index and your portfolio so that you take that into consideration? Great question, Michael. There are some calculators online. I can, if you send me an email at info@optionsplay.com, I can take a look at that. Now, I would say that most brokerage firms provide these types of tools already. Most brokerage firms provide what they call like a portfolio X-ray or portfolio scanners. They give you a sense for what the constituents of your portfolio is, and they typically provide you with an idea as far as what your portfolio consists of. And those are usually a good place to start as far as understanding what your portfolio consists of. Al is saying, thank you so much for a great seminar. I will review this webinar after posting. Thank you so much, Al. How do you read the volume data from the graph? Which volume data are you referring to? If you don't mind, I'm happy to answer that question. Charles is saying, any thoughts on using 45 to 90-day ETF put spreads as a hedge on stocks or multiple stocks that are highly correlated to a particular ETF? Absolutely. You absolutely can use put spreads to buy protection, which obviously will only buy you protection up to a certain level, right? So meaning if you do have a catastrophic move to the downside, this will only protect you down to about 120. If you bought this put spread, meaning anything below 120, you're actually not buying protection for. So that's the only downside to buying a put spread. It's a little cheaper, but you're not getting as much protection. So when you do have a catastrophic move, you're only getting partial protection. Instead of using SPY, can one use SPX and minimize commissions? Yeah, so if you have a very large account, you absolutely can use larger contract sizes to reduce your commissions. Absolutely. Do you recommend put spreads to hedge? I think I just answered that question. It's not that you can use put spreads. Just keep in mind that there's the risk that if the stock does move significantly lower, that you're not going to get good coverage on that. Is there any way I can see Greeks for each strategy? Absolutely. So you can click on the blue share button, and there's a button here at the bottom that says explain Greeks, and we explain delta, theta, gamma, and vega, and we actually express it in dollar terms, so it's a little easier to understand because you usually think of these Greeks in terms of the impact from a dollar perspective. So that's why we always display these from a dollar perspective. Well done, as usual. You mentioned the resistance level on Q. Any other indicator you consider for a bullish breakout? So from my perspective, I don't really use many indicators. I use price as my primary indicator. So, I usually always look at horizontal support and resistance levels. From my perspective, that's the best indicator that I can use as price. Scott is saying, I don't have a question, but I have to say that I am uncomfortable with placing a trade without first doing the OptionsPlay site. Great service. Thank you so much, Scott. I really appreciate that. Brian, thanks, Tony. The more I see you demonstrate OptionsPlay, the more impressed I'm at with capability. Thank you so much, Brian. I really appreciate that. Dan is saying, I have 100 shares of Procter & Gamble at 125. I sold a cover call on June 28, 108 calls. How should I set up the insurance on that cover call? So you own it at 125, which is substantially higher cost basis. So how would I set up insurance on that cover call? So you're not necessarily selling insurance. You're not putting insurance on that cover call. You're putting insurance on the stock position that you have. So you're really protecting against the 100 shares of Procter & Gamble. So first of all, Procter & Gamble is pretty bullish right now. It's got a score of 9, technical score of 9. I'm certainly not in a, unless you somehow see that this is going to reverse here and you don't think it's going to go any higher, I don't know that now's the right time to buy protection on Procter & Gamble. As you can see, the trend quality here is still pretty strong. It had a few bad days, but really rallied right back up to 107. So this, in my opinion, is not the right time to buy puts on Procter & Gamble. If things break below this 102 level, then I'd say, hey, maybe it's time to start looking at buying some protection. But really, I'd like to see a crack below 100 on Procter & Gamble before I would say that this uptrend here is no longer intact and things are going to start getting ugly again. So again, being late is better than being early because being early certainly is cheap, but chances are you're going to lose everything. So that's why I advocate to be late on some of these. Bradley, thank you. Frank is saying, APD ran before I can order. Should I have chased or limit at your midpoint? So my general rule of thumb here is that you can certainly chase these, but to a certain degree, if you can buy something for within 10% of the original price that we told you, that's usually acceptable. If it's greater than 10% of our original published price, that's when I think that you're really kind of chasing things. So that's my rule of thumb, is about 10% from the original price that we suggested. Alex is saying, when buying a call or a put, do you buy at market or limit? Great question, Alex. I generally tend to find when I trade with any of the major brokers, placing a market order many times actually gets me a much better fill than placing a limit order. Like you said, you find that limit orders are frequently not filled and expire at the end of day. So Alex, first of all, when you're placing limit orders, generally speaking, you should place them at least about 5 cents off the mid price, unless it's something that's really, really liquid and just trades a couple of pennies wide. Um, but it really depends on your broker. So when you're trying out market orders, I would always try it out with one contract at a time, see how you get filled. And market orders will have very different results depending on the name that you're trading. So if you're trading a fairly liquid name, meaning anything in the top 2 to 300 in terms of market cap, you should be filled fairly easily on a market order at a very good price with any of the major brokers. But I always tell users, be careful when you place market orders because you can get a bad fill. But try it out with one contract. See how your brokerage firm handles that order, because it does vary heavily from broker to broker. So try one contract at a time. See if you get a good fill. If you do, then you can place an order for the rest with a market order. If you get a bad fill, then I would stay with a limit order on that specific, at least for that specific symbol. Um, Any other questions? So the question about the volume bars are simply just the volume. So there's not much to, there's lots of research on kind of how you want to read volume, and there's lots of different um, thought processes. As far as volume, it's really used more as a confirmation, more so than a signal. So if you see that the market is near a bottom, you generally want to, or if you think the market's near a bottom, you generally want to see that happen on a high volume day, meaning there's lots of buyers coming in. That will just confirm that that's likely a market bottom or a market top. So that's typically how volume is used. But there's lots of different research out there. I highly recommend you to take a look at some of the technical analysis books. They can provide a little bit of insight in that. Raymond, thank you so much. I really appreciate it. Any more questions regarding anything? If there are no more questions, I just want to thank everyone for taking the time out here this afternoon. I just want to put one piece of housekeeping. Next week, we're moving our webinar from Thursday to Wednesday. Same time on Wednesday, but 4:15 p.m. Eastern. But we're going to move it to Wednesday because I have a bit of traveling coming up. So I'm moving next week's webinar to Wednesday, and the following week we will not have a webinar, and we'll resume the following Thursday after that. So just for those of you that like to come every single week, just make sure you know that next week's webinar is moved to Wednesday. So thank you so much. I hope you guys have a great evening. I'll send out the recording in about half an hour, and I'll see you guys on the webinar next Wednesday. Have a great evening.